Welcome to the video tutorial Project Finance Types of Payment Obligations. The following topics are addressed: direct payment obligations, effects of guarantees, abstract payment obligations. The video tutorial will be concluded by a list of references and an imprint. What are direct payment obligations? The basic concept of project financing emphasizes cash flow-related lending and thus the self-liquidation effect. Therefore, the basic concept does not provide for recourse to sponsors. In reality, however, it is often necessary to adapt the basic concept. Limited or, more rarely, full recourse to the sponsors or other parties may be unavoidable. Technically, a direct payment obligation will be arranged by issuing a guarantee or a similar instrument in the favor of the project company. Typically, the guarantees are given by the equity sponsors. If possible, the guarantee is legally structured in such a way that the financing banks can demand that the project company makes use of the guarantee. In case of predefined events under the guarantee, direct payments are advanced to the project company and/or to the bank that will manage the project accounts. The guarantee may be limited in time or, in other words, phase-related. Usually a distinction is made between pre-completion support and post-completion support. In these cases, the guarantees only refer to the respective phases. This can be useful, for example, if the construction phase or the operating phase have different levels of risk. In addition, the amount of the guarantee can also be adjusted to the respective needs in the different project phases. For example, a guarantee can expire or be reduced in amount after successful completion. Furthermore, type-related guarantees can be distinguished. While a cash deficiency support is drawn when there is a liquidity shortfall, a non-cash support is needed for non-monetary stabilization of the project. The latter is the case, for example, if the sponsor provides its own creditworthiness and guarantees purchases by the project company or promises support in selling the output generated. Non-cash support is shown here in italics because it does not represent a direct payment obligation. Rather, it is an abstract payment obligation, which is discussed later. What are the effects of guarantees for the issuing parties? Direct payment obligations are potential liabilities that will be reflected in the financial statements of the issuing party. Initially, a guarantee constitutes a contingent liability. The guarantee is accounted for below the line in the form of a note to the financial statements, which refers to the contingent liability. If the risk of a claim is significantly increased by the guarantee issued, a provision for guarantees must be reported in the balance sheet. The provision leads to an expense entry in the profit and loss statement, which reduces equity capital by the corresponding amount. As a consequence, there is a deterioration of the financial key figures. If the guarantee is actually called, a liability is created towards the beneficiaries. If the guarantor does not have sufficient free liquid funds, it must take out a loan to meet its obligations to the project company. Although the guarantee may never be finally drawn, in the light of scenarios 1 and 2, project participants will be reluctant to establish direct payment obligations under guarantees. What are abstract payment obligations? Third parties may support the project by assuming abstract payment obligations instead of issuing direct payment obligations. The objective is to ensure the debt service capacity of the project. Typically, abstract payment obligations can be used to secure the construction as well as the operation, maintenance and management of the project within the planned specifications. Furthermore, the supply with and/or sales of goods and services can be guaranteed in terms of quantity, quality, price and time. Hereby, a poor performance by the project company is ruled out from the outset or passed on directly to the relevant and responsible project participants. Furthermore, if-then clauses in the agreements offer flexibility, in other words, the possibility to switch abstract payment obligations on or off as needed. In this way, a temporal and functional flexibility can be created, which increases the acceptance of the obligated parties to support the project company by abstract payment obligations. This would be the case, for example, if a project company is not able to sell its products on the market. Then a sponsor could be obliged to buy the products.